You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, we're going to do a little bit of a rinse and repeat this week. Last week, we looked at United Airlines, and we were following some unusual option activity. Last week, somebody actually placed a fairly big trade on the April 1st United Airlines call option. The underlying stock was trading right around 60 when that trade came in. And the people bought about 1,400 contracts, paid around 85 cents for the 70 call, and that had an expiration date on April 1st. Speculative, to say the least. So we kind of looked at the trade and thought, well, that's a little bit too speculative for us. Let's spread that trade off. So we went out, used the same expiration, and bought the April 65 call and then sold the April 70 call. We did this for a net debit of 108 to the account, but that was just hoping that United Airlines would actually get up to 65, at least in the short term, as opposed to getting all the way up to 70. So we would like the stock to approach 70 if we could, obviously, but that didn't happen. The marketplace just basically decided that it was time to sell airlines. Overall, there wasn't any major reason why except for the fact that the airlines have had a good run recently. So right now we see United Airlines trading at 56.31. We are taping Options Playbook Radio, and the markets are open as we tape today. It is Wednesday, March 24th. So with that said, if you didn't get out of our little long spread already, there really isn't much to trade because the market is down a little bit, and you can let it run. It's a very volatile underlying stock, so maybe you just let it run and play the hope game overall. We did manage our risk by doing a spread, and with the total cost of the trade was $108 plus commission to put the trade on. And this week, let's just do a rinse and repeat. Let's continue looking at United Airlines, but here's the way I would approach it overall, not necessarily just chasing the volume. I would look at getting more volatility in the underlying than what the implied volatility is implying. So we're going to do a volatility spread, otherwise known as a back spread, and we're going to go out further in time. Now, United Airlines will be announcing earnings, and a lot of the airlines at the end of April. We're getting into the earnings season. We do want to avoid that. But we're going to look at doing a a back spread with calls. We're going to be a little bit more bullish than bearish on the underlying, but we're going to do a trade that will profit no matter which direction the underlying goes, as long as it makes a big move. So how do we do that? Well, we're going to go out to the April 24th expiration. And as I mentioned, a lot of people will reference this as a volatility spread. They'll call it a 1/2, which is also known as a ratio spread. So a little bit more sophisticated trade this week than just a simple long call spread that we looked at last week. So the underlying stock right now, as we speak, is at 56.31. We're going to actually buy the 56 strike call. It'll be the April expiration, but we're going to buy 2 of them for every 1 call option that we sell. We're going to go deeper in the money, and we're going to sell an expensive option contract. We're going to sell the 49 strike call. So this is a 7-point wide spread, and we're going to get this done for a net credit of $1.43 to the account. So it's a 1/2 and April 23rd expiration, selling the 49 strike call and buying 2 of the 56 strike calls. Now, if we do this trade, what we're ideally doing is selling a credit spread to try to pay for an extra call. So what does that mean? The credit spread wants the market to go down and finish below the strike that we sold, which would be the 49 strike. And the extra call wants the market to go up. So if the market does go up and actually is hurting the short call spread, we need it to go up quite a bit because we're long 1 extra call option. So we're looking for a big move to the upside. But the bottom line is we need at least a 7-point move in either direction to try to remain profitable on this position. So if we look at the long straddle for April, the April 23rd expiration, we do see that the long straddle is trading for just over $7. So the marketplace is anticipating that 7-point move, saying that it is possible. And that's usually the case when you're doing a ratio spread like this, that if you're selling the 7-point wide spread, that's usually about where the market is and anticipating the move to be. So I've always found that if I've set these up where I'm just looking for more volatility than less, but I'm bringing in a net credit to the account as opposed to just buying the straddle outright, this is a trade that I would consider. Now, you always got to pick a direction. And ideally with the airlines at this moment, it's really just flipping a coin because they're trading more so off of speculation than fundamentals. The books don't look great, but the marketplace has, or I should say the government has been willing to bail them out. They've given them a lot of money in loans and also just flat out grants to try to keep that industry afloat. So even though the books might not look the best, it's been proven that the government is willing to bail them out and keep them up and running. So that's going to be the trade this week. And let's just talk a little bit about, if we do this trade, what exactly do we want to happen? This is a trade that you really need to look at it on a profit and loss position, because it looks much different at expiration than it does on day 1 of the trade. In this instance, we are buying at the money option contracts, and we do, if it's going to go to the upside, you want it to go sooner rather than later, in that we are long 2 at the money call options that are going to be susceptible to time decay. So we'd like that 7-point move to happen right away if we can. And if it does, if it makes more than a 7-point move, this is a very rewarding type trade. We've already seen that move this week. I mean, last week we were looking at United Airlines. It was trading at 62, and this week it's trading at 56. So it's already made that type of move, but it was to the downside. If it continues on the downside, that's fine. No worries in this trade, as long as it makes an equal move and it goes down below that 49 strike call. Now, on the upside, we would love it to get all the way up to that 70 target that the unusual activity was targeting. And I do want to let you know that I was watching some of that activity, and they did get out of the trade. In other words, looking at the open interest, it looked like they didn't just sit there and take their comeuppance and say, oh, I'm wrong. They actually sold their position, and not sure what they got out at, but they did try to salvage as much as they could on that large option trade. All right, so a lot of times with the back spread with calls, a lot of people will actually call this a pay later call. And I'd like to mention that, and I have that inside the options playbook as an alternative name for the strategy. And the reason why is instead of just buying your call option outright, we're selling a spread to pay for it. So when I do that scenario, I have to put up the capital for the short spread. In other words, this isn't a cheap play to put on. We're bringing in a nice net credit of $1.43 if we can fill at the midpoint. But we have to be able to put up the difference between the strikes, which is 7 points. So 7 minus $1.43 is our actual risk, and we'll have to have at least that amount in margin. We can bring in that $1.43, but we would need an additional $5.57 or $557 to put this trade on, and that would be our maximum risk. Now, the only way we lose that risk lose that amount is if the market goes right to 56 and stays there for all the way out to the April 23rd expiration and stops right at 56. So it's very similar to a butterfly trade in that a butterfly trade is very hard to get the maximum when you put that trade on. In this situation, it's very hard to lose the maximum if you put the trade on because the marketplace has to basically stop right at your long strike overall. So in the short term, for the next 14 days or so, there's not a ton of risk as long as the 56 strike call option maintains some of its time premium. And right now, the midpoint on that call option is right about $3.25 overall. And as long as it saves some of that time premium, this trade will be okay. So I would look at this, even though we're going out to April 23rd, in 14 to 18 days, I want to think about just getting out of the trade because I do not want to lose that maximum on the trade. So, for example, if I go and get a quote a couple of weeks from now and the stock is still trading at 56, just close the trade and move on. In other words, salvage the time premium that's still in that 56 strike call. But airlines have proven to be volatile. So this is the way that I would approach the airlines at this point in time. Back in the day, we talked a lot about FOMO trades in airlines and we looked at buying deeper in the money call options just in case there was a vaccine. And approached it that way and managed our risk using options just by saying, well, if we get some good news on the vaccine front, we should see a pop up in the airlines. And that's been true about the entire marketplace. You never knew when that vaccine might have been announced, but it came sooner rather than later in general. And the markets have obviously received that information pretty well, especially in the travel stocks like the airlines. Okay, so let's recap. Here's what we're looking at doing for Options Playbook Radio. Last week, we looked at United Airlines, and that trade was definitely not a winning trade overall. Looked at paying $1.08 net debit to the account, or $108 for our 1-by-1 long spread. This week, we're just going to do a trade that's going to bring in that amount of credit, but we're just looking for the same type of move that we had last week. We would like it to be to the upside, but if it goes to the downside, we're going to hedge ourselves by doing this back spread. So We're going to go out to the April 23rd expiration. We're going to sell the 49 strike call, one of them, and then we're going to buy 2 of the 56 strike call options. We're going to try to get this done for a net credit of $1.43 to the account, or $143. On the upside, we have unlimited upside potential. On the downside, if we get a big move to the downside, we could receive that net credit of $1.43, which would actually cover the costs of the long spread overall. And we do have to put up some margin. The maximum risk of this trade would be $5.57, which is the difference between the strikes minus that net credit received to the account overall. All right, and that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. It's very simple, at Brian Overby. Until then, may all the options you bought finish in the money and all the ones you've sold finished out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.